Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those four indices, we'll also take a quick look at the U.S. dollar. We'll look at oil, gold, silver, possibly Bitcoin, and then move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. Be more than happy to take a look at it once we finish looking at the market and commodities. If you are watching this as a video later on, you can always find me on Twitter at StockDarts. You can find these videos at StockDarts on YouTube, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, as well as generally just expanding on some of the information we come across during these Wednesday market reviews. Typically, we try to analyze what type of price environment we're in, and then I structure trades based off of that, and that's usually where you'll find the trade ideas is at the Patreon website. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 with the ETF SPY. So let's jump on there. And we've had an interesting week. We started off pretty strongly. Last week was actually the first bit of strong selling we've seen really in the beginning of 2021. And even if we go all the way back to the end of last year, we've usually had one or two red candles, and then it's followed by a lot of green candles. And this was the first time that we had a string of several candles in a row that actually pushed us through some technical levels. However, it was met with buyers as usual. And for the moment, the market has found support and is again trying to make its way back up to all-time highs. I feel like the market is starting to slow down. I felt like that even at the start of the year. However, until it actually shows us more technical proof that it's slowing down and turning down sideways, we have to continue to assume that we're still in a rally and we're still going to continue to climb higher. So what we have right now is we had the first chink in the armor as far as this rally, and by rally I'm going to talk about just the short-term rally, the one that started as we started to approach the holiday season. So the one that started right around the beginning of November, where we broke out from above this 340, 342 level, this descending trend line that was looking like a double top on the S&P 500, where we had a surge up to about 356, and then we dropped. We came back up and we fell just a bit short of that, and then we dropped. And then so since then we've actually had a very strong rally to close out last year and to start this year. And this is the first time that we lost the 20-day moving average, and then we came all the way down. We tested the 50. Those of you that were in here last week, you know that I mentioned that typically in a strongly trending equity, whether it's an ETF, whether it's the market, whether it's just a random stock, when you have the 20 and the 50-day moving average climbing upwards in a nice 45-degree angle, usually when you lose the 20, you'll come down and you'll test the 50, and then you'll chop right back up and test the 20 again, and you'll have this back and forth action in between the two moving averages. More often than not, it resolves back in the direction of the previous trend, and which is what happened so far in this case, which is it came right back up above the 20. Typically the first test of a 50, if you're in a strong trend, is usually a successful test for the bulls. It doesn't always happen that way. Sometimes you shake out a little and you go even further down. Sometimes it just rolls right over. But more often than not, you can expect that first test of the moving averages to work, because again, these moving averages are showing you a strong trend in place and strong sentiment, and it usually takes more than just a couple candles to change that sentiment or to get a major shift in market psychology. So more often than not, what you'll get is you'll get a chop back and forth between the two averages. Give price a little bit of time to digest the new information, the new place that we're at, find new buyers to step in that have been waiting. Because what happens a lot of times when you have a market that's slowly climbing up higher and higher is you start to get this imbalance, because smart money or cautious money is waiting for a pullback to buy, right? And the higher and higher it goes up, the weaker the hands that are jumping in are, because they keep chasing the price action. So sooner or later you get these corrections and you get these quick moves down, which shake out, you basically shake the tree loose a little bit, and then you get new buyers to step in at what they consider to be good value prices. And that's how the typical market dynamic works, particularly in a bull run, where people are looking for higher prices but are still wanting to buy it at value. They typically wait, instead of waiting for a full move all the way down to whatever the previous level of support was, they try to figure out where they could buy and still catch the trend. And so you'll often see moving averages. You'll see channels where they try to buy the bottom of that channel. And sometimes it's a little bit up for interpretation. For instance, this trend line that I have drawn here, you can actually, and there will be many traders that will have a triangle or have their channel sort of like this. And it's not wrong. It's not any different than the other one I drew. It's just giving you an approximation of what the sentiment is and what the trend is. And as you can see, people tried to buy, whether they were buying the 50-day moving average, whether they were trying to buy this trend, they're trying to buy a pullback within a larger uptrend. And so they're waiting for these moves down to these areas, and more often than not, they do work. Now, it doesn't always happen, and sooner or later, these levels do break, especially the more and more they get tested. And so what we have now is we had a successful retest of the 50. We had a successful test of this ascending trend line to a certain extent. And now we're making our way back up towards the top of the channel, or towards new all-time highs, which again, if we wanted to draw a horizontal line, would be somewhere here around 385 or so. Now, the big key is what's going to happen when the market comes back up. You can see we're about to fill a gap that we haven't quite filled yet, but are we going to encounter the same sort of distribution, the same sort of supply that we encountered last week? And if so, is that going to push the market all the way back down to the lows from last week, or are we going to continue to kind of ride this channel a bit higher? And I think that's where we stand right now. We had Amazon and Google report earnings yesterday. Apple and Facebook reported last week. So we've got most of the major names out of the way. We still have some other big names reporting today and tomorrow, but after that, we'll be through the meat of earnings season. There's still plenty of names that are going to report next week and the week after that, but a lot of the big names have already reported, and so we are losing some catalysts as far as how the market can move. Last week we had an FOMC meeting, and we had some major earnings announcements, and it moved the needle a bit. Right, the market did drop, and the market actually dropped pretty significantly on the Wednesday of the FOMC. And then we kind of stabilized, and then of course this week we've kind of made our way back up. The other catalyst that was starting to impact the market was all the shenanigans going on with GameStop, and we went over that last week, so I'm not going to spend too much time with that this week. But that actually was a little bit of a dark cloud hanging over the market, despite the fact that myself, along with many others, were actually happy to see GameStop run up and to see some of the big money and some of the hedge funds get hit with their own medicine for once. However, that did put a little bit of a threat on the market, because if Melvin Capital was going to end up going bankrupt, then they were going to have to liquidate a lot of long positions, which was going to put a lot of selling pressure on the overall market. And that could have ended up leading to a cascading event where it could have started dropping, more stocks could have started dropping along with it. So that was a potential catalyst for a stronger market correction than what we saw. So we've kind of gone past that. We've gone past FOMC, and we've gone past earnings season, and the market's still right where it wants to be, which is trying to make its way back up to all-time highs. And so despite the fact that I feel like the market is feeling heavier than it has been since basically back in September and October, you're not seeing it yet, or I'm not seeing it yet in the price action. And so the idea here is we got to respect price action first. Our opinions on the market really don't matter. What matters is what the market does. And so we will continue to respect the price action, and I will continue playing to the long side and looking for dips to buy until I see a different sort of behavior coming out of the market. Now, even if we get a stronger correction, as I mentioned last week, and I've mentioned pretty much since the start of the year, I think it leads to a sideways market, not a market that's going to top and start to really drop a lot. So my bullish stance will continue even if we see more selling pressure. However, it might change the styles of trades that I take, and I might look at more range-based strategies rather than looking to trade long trades like this, where when a stock is trading in an uptrend like this, you want to buy dips down to support, but you also want to kind of ride the wave up and kind of trail your stop and try to figure out how much more you can get out of it. When a market is moving sideways, or a stock is moving sideways, you tend to have a little bit more static levels or targets as far as what you want for support and resistance, and you tend not to try to trail a stop, and you just want to go ahead and take your profit as it hits whatever the previous level of resistance is. And so right now we're still in the moment of trying to figure out how much more momentum is left in this market, but until it changes, we have to just continue to ride it and continue to play it along, until it tells us differently. Now, what are some levels that we want to watch on the S&P 500? Well, looking at SPY, we've already outlined a couple just by looking at the price action from the last couple of weeks, but we have pretty stiff resistance up here right below 385. We have pretty decent support now down here around 370, which was where we had this sort of turn on the 50-day moving average. I think the 20 at this point is probably going to get violated again as we continue to chop back and forth. As you can see, it's slowly and slowly getting more and more or less respected, I would say, and more violated as we move through this channel. And this is going to, of course, going to happen. So just a numbers game. Moving averages eventually have to catch up to price, or price catches up to moving averages, just the way math works. But as you can see, we started off with, we didn't even touch it, then we touched it, then we breached it for a second, then we breached it for a little bit longer, and we breached it for even longer. So at this point, the 20-day moving average is not something I'd be looking at as far as support. Matter of fact, I'd expect price to kind of go back and forth, in the 20 to be in the middle of price until we see a bigger change in momentum. However, I think the 50 should still hold a support at least for one more test, and the bottom of this trend line should again hold at least until we come down to it. And then if we break that, it will likely lead to a move down to either 368 or possibly down to about 365 or so. And that should probably hold a support, at least initially, with a further move downside, maybe to about 358, which would again would be this zone here. And I'm gonna change. Let's reappropriate this rectangle. So ultimately, this zone here would be the major level of support that we can assume is going to hold as we move forward into the middle to the end of February and into March. If we do start to see more selling pressure in the market, this is the area that I would expect to be a major level of support that should hold, at least initially. You can see there's a lot of room to the downside from here to there, about 30 points. So even though I'm recommending us to trade to the long side because we're in a bull market, that doesn't mean you should ignore your stops or just kind of ignore market discipline, because there's still a lot of room for us to drop and have the market in a strong bull market, just needed to come back and retest and kind of refill some of these spaces from beyond. Matter of fact, we can come all the way down to 337 and we'll still be in a pretty healthy market. If you take a look at the weekly chart and you see just where the market has been and what it's done since March, and you can see there's a lot of room for us to come back down and still be in a pretty healthy market and still be in an intact bull market that's holding well above all the price action from 2017, 2018, and 2019. So, I guess the one thing I want you guys to come across as far as today's concerned is, even if the market does find more selling pressure here, I think our overall bull market is still intact, and we shouldn't be too nervous about buying dips. Just making sure that we use proper discipline and proper risk management when we go ahead and try to trade this. So my stance hasn't changed. I'm not looking for a market top right now, despite the fact that I feel like the market might need to correct a bit more in the near future. Until it does so, I'm going to go ahead and keep trading to the long side and keep trying to take advantage of this momentum. And eventually, when it does drop, I'll still be looking to buy the dip, but I might reevaluate a bit and change my stance and change my trading style to take more advantage of sideways trades rather than just trying to take advantage of upwards momentum. All right, so that's the S&P 500. If I had to guess, from here to next Wednesday, we're probably going to come up to fill this gap probably today, and then maybe test the 384, 385 tomorrow. But we're probably going to stall out and come right back down and chop through the 20 and continue to kind of go back and forth as we find more buyers that are ready to step up and buy at this level. I don't think that we found some demand and we found some buying here at the 50. I don't know that we have much over here in the 384, 385 levels. So my guess is that we're probably going to stall out over the next couple of days and then come right back down and re-challenge the 50-day moving average and this trend line that's developing on the S&P 500. Now, if we go over to the NASDAQ, we're going to see a little bit of a different picture. And of course, that's because Amazon had good earnings, Google had good earnings. So if we go ahead and take a look, I'm going to go real quick to Amazon, which reported last night. And as you can see, it's not a fantastic earnings report. They're only up 0.5%, but they are up. And they're kind of climbing up a little bit after dropping midway. This is pretty interesting because they had, Jeff Bezos decided to step down as CEO, and the market didn't flinch, and it didn't really care about that. They had blowout earnings as far as numbers are concerned, and overall, it still looks like a stock that's ready to come up and re-challenge highs. You'll notice a couple things on here. This white rectangle was showing what the expected move was by the options, and as you could tell, this was a pretty tame report considering it came nowhere near either edge of the, or either of the extremes of that volatility that was expected. So overall, it was a positive report, even if it was maybe a little bit lukewarm reception. And then the other one, of course, was Google, which is up about 8% today, and that actually had a pretty nice move. And so if you look at it, pretty much all the FANG stocks had pretty decent earnings reports, and that, of course, has buoyed the Qs to their current levels, which is all-time highs, right at all-time highs. So relatively speaking, the NASDAQ is picking up some strength and maybe taking over, assuming a leadership role in the market once again. There was a point there where the NASDAQ took a back seat to the Russell 2000, and IWM was leading the way, particularly towards the holidays and at the very start of this year. However, that started to shift again, and we're starting to see tech take up more of a leadership role as it starts to gain a little bit of relative strength versus its peers. And that's pretty evident right now. As you can see, they're kind of hovering near all-time highs. Now, like I mentioned with the SPY, the big question is, do we have enough strength to push past this? Because as you can see, we're going to zoom in. Even today's candle, we've got another little hammer. A hammer, you can see another hammer candle up here, another hammer candle here, shooting star here, a little doji. A hammer at highs is not a bullish candle. I know we get conditioned to assume that hammer candles are always bullish, but they're only bullish when you're down at support levels. When you're up near resistance, that shows that there's actually selling pressure. And even if the buyers are able to take control and run it back up towards the close of the day, it still shows that there is supply there that is starting to affect the price action. And so you don't typically want to see hammers at highs. You want to see these nice big green candles that push right through there and never really waver during the middle of the day. So, we've got a point here where we're opening high, we're dropping, and then we're kind of closing back close to the highs, which of course is better than closing down by the lows, but it's showing that there's a little bit of indecision here in the market. And so until we see the change in that, my guess is that we're probably going to find more selling pressure and may have to come back down and test the 20 again. Now you'll notice, again, showing relative strength, the NASDAQ didn't test the 50. Didn't come anywhere near testing the 50, actually. It tested the 20, tested this ascending trend line, and so again, the tech area continues to behave well and continues to show strength relative to the markets and relative to pretty much anything else. And so overall, again, if you are someone that wants to trade long, this is still a good area to be involved, as it has been for all of this year and all of last year. And I don't see that really changing anytime soon. I still think this is the best area of the market to try to invest and to try to trade, and I think it's the safest area as far as you can define safety in the market. Now, key levels to watch, I think they all kind of coincide around the same level, which is right around 315, 316, which again is where we broke out from the most recent kind of consolidation range. It also happens to be right where this trend line is. It also happens to be right around where the 20-day moving average is. It also happens to be right around where the lows from last week were. So there's this big convergence of a lot of different levels of what could be support developing right around 317 and a little bit above it and a little bit below it. So if we do stall out at highs and come back down, I would expect that area to kind of act as support and kind of be an area where buyers want to step in and support the price action. If we do get more selling pressure than that, well, the next level down would be the 50-day moving average, which again is slowly rising, trying to catch up to price, and which has not been tested by the NASDAQ. Similar to what I mentioned with the SPY, if we do test the 50 on the NASDAQ, it's a good chance that it holds and we come back and test the 20, although it'll be a little bit interesting to see, because if we do test the 50 on the NASDAQ, that means the SPY probably tested their 50 and failed. And so we'll have to get a better idea of what exactly is going on there, unless we get a little bit more shenanigans with market rotation. But that's something that we can't really predict at this time. So my thought process here with the NASDAQ is it is the strongest index. If there's one index right now that will probably break to new all-time highs, it will be the Qs. And if they want to take a stronger leadership position in the market, we'll see a big green candle leading up, which will drag the SPY and IWM and the Dow along with it. If we falter here and we drop down, well, then the key is to make sure that we maintain this upwards trend and that we don't kind of downshift and start trading sideways and start looking at some of these horizontal levels that I have marked off, like 308, or just like the S&P 500, the critical area, the top of what was looking to be a double top back in September and October, somewhere between about 303 to about 299. So basically the area right around 300. And that would be the major level of support and an area that I would be looking to buy a dip if we did happen to come down to that price point. And that would be, again, a good place, I think, if we did have a stronger correction. However, for now, we're not looking at stronger corrections. We're just looking at whether price action will continue to erode and whether the strength will get a little bit weaker. But we're still in a very strong market. As we can see, we're at all-time highs, and we still have a trend that's intact that hasn't really been broken. So that should be our major concern right now, is the short term. Whether we hold a 20, whether we hold this 316. If we drop that, then we start to worry about how far we want to go before we want to buy dips. But I suspect the 50 will be an easy spot to look at on the NASDAQ. Now, if we go to the Dow Jones, we'll see a different picture, much weaker, particularly when you compare to the NASDAQ, but even compared to the S&P 500, you'll see we haven't gotten back above the 20. Matter of fact, we're still below this ascending trend line, and we're still kind of hovering right around the 50. So, this is actually the worst of the three as far as what we could see. It's chopping between the two moving averages. It hasn't been able to break past it. Matter of fact, you can see a lot of, we're going to zoom in again, a lot of selling pressure here, even as we tried to break back above this trend line. Look at the wicks over here and over here as we tried to break back above that and tried to get back above the 20s. So the Dow is getting beat down pretty quickly as it tries to make its way back up. And right now, this is actually a pretty classic bearish pattern where you have a trend in place, you fail as you try to break past it, and then you drop, and then when you come up and try to get back into that trend, you fail, which is what's happening so far. We tried to get back above that trend line and we failed. We tried a second time and failed. And more often than not, this leads to a bearish wedge pattern here. Which typically leads to a drop down, right? And so what we have here is we have a little bit of a divergence and a little bit of discord between the major market indices, because we have the NASDAQ, which is looking to go to new all-time highs, and yet we have the Dow Jones printing what appears to be a bearish pattern. Now, when I see something like this, it more than anything tells me that the market is probably going to chop, because you have different areas of the market that are pulling in different directions. And so we may get some more bearishness on the Dow, or it might be that the NASDAQ stalls out and the Dow tries to catch up and the SPY tries to catch up. We don't really know what's going to happen yet, but when we understand that we have this discord and we have this kind of disparity between the major market indices, more than anything, the likelihood is that we're going to get chopped as these try to kind of maneuver and try to get back on the same page. And at the moment, as we can see, they're clearly not on the same page. We have a pretty decent downtrend starting to develop, and that needs to be broken. And as you can see, price is getting caught up between two trends, and we're going to color them just so I can outline a little bit easier for you guys. We have the bullish trend. Actually, we'll do this way. The bearish trend. And this technically is a short-term bullish move, right? So we've got sentiment in the very short term trying to push it up, and we've got sentiment in the intermediate term trying to push it down. Now, long-term sentiment is this one here, right, which is bullish, right? However, what we have here is we have a battle between sellers that are trying to push the Dow down and buyers that are trying to push it up. And as you can see, we've reached the point where someone's going to have to win very soon. And where that happens, we'll see, and whether that's going to end up in a move down or move up has yet to be determined. However, like I said, this is typically a bearish pattern when you have a drop through a trend and then you come up and you can't get back above it. So the bulls are going to have to push the price action back above 308, get it above this red line, get it above the 20-day moving average, get it above these two wicks here, And then if that's the case, then we can likely expect the Dow to make its way back up to 311 or close to new all-time highs. If it falters here and fails, well, we're going to come back and test the 50 and likely break below it. And the question will be, does the SPY and the NASDAQ correct alongside that? So this is an area that we want to watch. We'll see what happens between here and next Wednesday. And although I consider the NASDAQ to be leading, the Dow might give us the clearest picture of what's going to happen next, depending on how it navigates these two differing sentiments that are kind of in the middle of a battle right now. Now, finally, the last thing we want to look at is IWM. Looking at the small caps, and as you can see, the small caps have been, relatively speaking, still pretty strong. Now, they've weakened up a bit compared to the NASDAQ. As you can see, we're not at all-time highs yet. But just like the NASDAQ, we didn't come anywhere near the 50-day moving average. We held up pretty well at the 20, and we're still pretty close to all-time highs. And so this is still an area where traders are still coming in and trying to take risk and trying to go ahead and take advantage of some of the small cap moves. And as long as this continues, then I think the market is still in a good state. This was one of my barometers for market health, was how IWM kind of continues to shape up. They've been very weak throughout the last few years, and they finally started to pick up some strength as we hit the holiday season. And I think that's a good sign for the market in general, because this is an area that was pretty tired and pretty beat up throughout 2020, and even before that into 2019 and 2018, it was lagging quite a bit behind the NASDAQ and the S&P 500. So it's good to see that it's still holding up relatively well. However, much like the NASDAQ and the Dow, IWM is doing a little bit of what each of them is doing. So in the very short term, we have a very similar pattern to what we just saw in the Dow Jones. Now again, this is pretty short term. It's not something that I would be too worried about at the moment. But as you can see, we've got a similar pattern developing where we had a channel that we broke down and we're trying to get back above it. Now, unlike the Dow, we actually did get back above the horizontal level, and we also did break the prevailing downtrend, which was pretty steep, right? So it's not quite the same as the Dow, but you can see there was a similar pattern. It's also very similar to the NASDAQ in that it is getting very close to all-time highs and making its way to challenge them. So depending on how you interpret it, we got a little bit of both. And actually, this might be a good tell, as it was doing something similar to the Dow, but it was able to get past it. So if IWM continues to pull up through here, it could possibly pull the Dow back through and have the Dow copy the same sort of pattern. So if we look at all four indices together, I would say it's a bullish picture more than a bearish picture, because the Dow is really the only index that's kind of printing something bearish, and it's not really that bearish. It's just short-term momentum that's really starting to slow down. However, the other indices I think are still kind of showing us good things, and like I said, my expectation is that the S&P 500 and the NASDAQ, and maybe even IWM, tries to make it to all-time highs. I don't expect it to be a breakout that holds, and we're likely going to turn right back around and come back and test our moving averages. So probably the prediction that makes the most sense from here next Wednesday is that the market's going to chop back and forth. I don't think we're going to get a strong rally to the upside, and I don't think we get a correction with any kind of strength to the downside. Probably just going back and retesting some of these moving averages at some of these levels to the upside and downside that are pretty close to price. Okay, so what does that mean for us trading? That means we probably want to be a little bit quicker about taking profits on moves that work in our favor, and make sure that we are not trying to marry our positions right now, making sure that we just take advantage of the momentum and don't kind of get caught up if it does start to slow down on us. All right, let's take a quick look at the US dollar. We'll look at oil, gold, silver, Bitcoin, and then we'll move on to any charts that someone might have. We'll also look at a couple of our trades from last week that worked out pretty well for us. So here's the UUP index. As you can see, the dollar picked up a bit of strength. Interestingly enough, after the FOMC meeting, even though they didn't say anything, they said they were not going to raise rates anytime soon, but it was still good for the dollar, maybe a little bit of a sell and use type of thing. And it's actually making its way up, and we're seeing the beginnings of a trend change. Look at the 20-day moving average starting to curl up and come up and try to cut through the 50 days. So uh, we're actually seeing the dollar stabilize and start to climb. And this is, probably a good sign. There's only so much downside we can see on the dollar where it really could start to affect our economy. So we want the dollar to still be stable. Now, a weaker dollar is usually good for prices of commodities or prices of pretty much anything. But you don't want it so weak that it basically leads to like an inflationary cycle. So it's good to see a little bit of strength coming in. I don't know how much more strength we see on this. There's still going to be a massive overhead resistance as we come up and challenge some of these areas above here. But for now, the good thing is we are seeing a little bit of strength coming into the US dollar. If we look at the Euro US dollar cross, and again, that's going to be inverse to what we just saw in the UUP, you can see again the euro starting to kind of break down through some of these key areas. Now, you'll note, again, what I mentioned before, this behavior going back and testing the 50, then testing the 20, but in this case, it didn't resolve in the direction of the prior trend. It actually rolled right back over and came down and cut back through the 50 and is heading a little bit lower. Now, there is room all the way down to about 119 before we find major support on the euro. So there's a little bit of more strength that the US dollar can show before it hits a level that is probably not ready to breach. So that could lead to a little bit more dollar strength in the coming days. However, there's always the chance the euro tries to bounce right back up and test the 20. But at this point, if it can't break past through the 20, then it's likely going to lead to lower prices. If we look at the US dollar Canadian, this is going to be the more interesting cross, where we're seeing the dollar actually show some strength, but it's struggling because oil is showing strength. And typically, if oil is strong, that's going to be good for the Canadian dollar. So, of the the three currency crosses we're looking at right now, I think this is the one the U.S. dollar is facing the strongest headwinds and is going to have the hardest time kind of curling back through. But even then, we're seeing the 20-day moving average starting to kind of turn back up, and we saw it challenging the 50-day. And even if it failed at this time, it is trying to break through and it's trying to make its way higher. So, overall, again, still showing some strength here for the U.S. dollar. And then finally, the U.S. dollar had a big breakout versus the yen. As you can see, we mentioned this last week. There's a major trend here that it finally broke, and it had a pretty big price explosion through there. There is more room to the upside before it hits major levels of resistance. However, as you can see, it's probably getting a little bit tired. You can see we had a big move and another big move, and now the wicks are starting to show up on the top of the price action. So there's a decent chance that it kind of corrects here and takes a break. But I think the key to point out here is the dollar is starting to gain strength and is maybe reached the point where we found a pretty good bottom, and we can start looking at it as at least a neutral instrument. And of course, that's going to put more pressure on gold and silver. Now, you'll notice GLD not looking good at all, looking like it's going to roll right back over. Like I mentioned last week, I'm not interested in gold right now. I'm not interested in silver despite what we've seen on it recently, which we'll get to in a second. But gold definitely struggling, and if the dollar continues to show strength, we're going to see new lows on gold. Now, if the dollar does pull back and struggles, we could see GLD make its way back up through the 170s and make its way back up maybe to 176 or so. But again, this is not a bullish chart. This is not the kind of chart that I want to buy right now. There are much better trades in other areas, and I'm not really interested in this as a long-term trade, at least as far as initiating new holdings on right now. So this one doesn't interest me now. Well, silver had something different going on. Silver kind of caught a little bit of that GameStop momentum. Last week we looked at how GameStop was really taking off and how there was a lot of money flooding into other potential short selling positions. So we had stuff like so let's just go real quick and look at what GameStop has done, and you can see GameStop is the short squeeze is pretty much dead at this point. It could try to rally again and make its way back up higher, but as you can see, the short squeeze for the most part has kind of run its course. A lot of that had to do with the shenanigans that a lot of the brokers pulled last week to kind of stop people from buying. But I'm not, whatever. That's not something we need to get into. What I want to get into is just the charts that are related to this. As you can see, GameStop kind of came down and is starting to struggle. And what we saw was, as GameStop really started to explode, people tried to do the same thing with a lot of other stocks. You can see AMC kind of did something very similar. I think the other one was it like Voss or something. No, I can't remember the name of the other one, but there was another one that was like that. Uh, and then I know Bed Bath and Beyond was another one that we looked at last week. Uh, they tried to do it with Macy's, I believe. You can see a lot of these crappy names. They started to take off, but it was short-lived because there wasn't the same concerted effort that people took on GameStop. And so another one that everyone thought was going to be the case was going to be silver. Silver's a pretty heavily shorted commodity. It's been in the news before. There was a time a few years ago where I believe it was J.P. Morgan that was trying to short it, and other hedge funds tried to do to it what the Reddit users did to GameStop, and there was a big battle about it. But the problem with silver is that it has a pretty high float, and obviously it's a commodity. It's not the same as just trading a stock with a certain market cap, and unless there's a strongly concerted effort to drive prices up, it's going to be hard to kind of manipulate this. And so it had a big gap up, but it's given it all back. And I'm not really, I'm not interested in this as kind of a mimic play on the GameStop. I don't think that there's enough. I don't think there's enough effort here to push this up like there was with GME. I think with GME there was a lot of traders that got into it and wanted to do it, and then there's been some offshoots of smaller groups that want to try it with other names. But until you see everybody trying to do it together, it's not going to affect something like silver. So I'm not interested in silver, long or short at the moment. If it's going to trade, if it's going to squeeze again, more power to whoever does it. That's not my style of trading. So I'm not going to go ahead and try to take that. It's also not my style to try to short something that people are trying to squeeze. So I have no interest in that as well. So basically this is a commodity, much like GLD, that I don't really have much interest in at the moment. Now the last one we want to look at is oil. Oil actually is picking up a lot of momentum again, and we can see we broke through 55. I expected 55 to be a pretty stiff ceiling on oil prices right now. As we can see, it's not really the case as we moved all the way up to 56. Typically, these three green candles in a row, there's like three marching soldiers, is usually a pretty good sign of a trend developing again. So there is the possibility that oil continues to go higher. Now again, this could be seen as positive because it's showing that the market is expecting our energy demand to go up and our society to continue to open up and continue to spend more money and continue to do more things. However, at a certain point it starts to put pressure on energy if energy prices start to go up. So there's a little bit of a balance here that needs to be struck between the rally we're seeing in oil right now versus what our economy can handle. Clearly at the moment our economy can handle this, and we're just rallying up strongly. And you'll find that energy names are doing the same thing as oil and are climbing higher. And if you find an energy name that is printing a pattern similar to this but hasn't broken out and is still maybe stuck here, that probably makes for a good trade and a good buy, because you can expect it to probably follow oil higher. So oil is a good area for us to look at, and we're looking for trades. And then finally, the last pseudo commodity we want to look at is Bitcoin, which again has picked up some strength, and we looked at this as a pretty critical price area last week, and it was able to break it, and now it's starting to run right back up, and I expect it to make its way back up to 38.6, maybe 39 to 40. Much like the market, I don't expect new all-time highs to hold, even if it does get there, but I do think it wants to come up and start challenging some of these previous areas. So overall, it's looking pretty good. The other part of the cryptocurrencies that are looking really good is Ethereum, and that continues to break out. And we mentioned that last week, and I mentioned how this is probably the better trade of the two. And as you can see, it has really blasted off here, going from 14 to 16 in the matter of just a couple of days, and is starting again, just like oil. We've got the three marching soldiers starting to climb up to new prices, and this should be a trend that holds a little bit longer and does well for anyone that's into cryptocurrencies and into trading this sort of stuff. So that covers it for the markets and the commodities and pseudo commodities, if you want to, cryptocurrencies that I like to follow. Anyone in here, if you have a chart request, feel free to type it in. Again, if anyone is watching this as a recording, you can always ask me on Twitter. Just look for the name @StockDarts, and I'll be more than happy to answer your questions on there. While I'm waiting to see if anyone has a chart request, I want to go ahead and go over. We went over this last week, but I just want to point out again, trade that worked out pretty well for us on Workhorse, and once again showing the kinds of trades that we like to look at here, which is stocks that are in consolidation ranges and pretty close to support, because they give us good risk versus the reward that we could possibly get, which in this case was a pretty quick move from about 25 all the way up to 40. So that was a pretty big move in our favor. Now the other one that moved for us last week was NVAX. Now again, this is a trade that we looked at last Monday. So in the span of a week and a couple of days, we've had major profits on two of these. And as you can see with NVAX, it kind of took a little bit of time, and its initial breakout was a little weak, but then it gapped up, and at this point has given us a massive move of more than 130 points, and has obviously become a really good winner for us as far as our trades are concerned. Now the trades, we had a couple trades that I mentioned yesterday. I don't want to put them up yet out of respect to our Patreon subscribers. If you're in here and you're a Patreon subscriber, you could read them anyway. But we already had a couple. We already had one or two of them that are starting to move up in our favor as well. So I think overall, the market has given us moves. We just have to make sure that we take the trades that we want. I had a friend of mine that's not into trading at all yesterday. Asked me about GameStop, and he's wondering why if I didn't trade. And he's like, "Oh, why aren't you trading?" And I was like, "Well, it's not my style of trade." And he really understands why I would say that. But in my mind, I could get a move like this, and look at the risk, right? We're risking $10 possibly on Novax, and we got over 100, so we got a 10 times move on our risk versus our reward, versus something like GameStop where I wasn't ready. I didn't know that this was going to break like this, and so I started watching it when it was already breaking from the 40s to the 60s and the 80s. But at that point, our risk reward, you're risking 30, 40, 50 points, and yeah, you ended up getting 200 or 300 points, but there's no way of knowing that ahead of time. These aren't the kinds of trades that I like to take, because I don't like, once I'm out of this, if I miss this initial move and it starts to get volatile like this, you can't really manage your risk at all, because you can get all kinds of overnight moves. You can get all the shenanigans that happen with the market makers. So that's not my style. My style is to find stuff like this that give us much better manageable risk versus reward. Now, if this thing gapped up, would I have traded it? No, because at that point, even though it did give us another 40, 50 points, the risk is just not worth it at that point, because we're looking at a stop at the very least 173 or 190. So unless you caught this on the initial breakout, which we were looking at, which again, we mentioned it when it was still here waiting to break out of that range, you didn't get this, and that's okay, because even if you missed this, we still had something like this which worked out perfectly fine for us, and again, gave us excellent risk reward. Again, you're risking from 23 to about 22, so maybe $1, maybe $2 if you give it a lot of wiggle room, and right away we're getting $10 to $15, right? So when you get that kind of risk reward, it makes up for something like the last trade we looked at last Monday was Coke. And so when you get those two that trade like that, it makes up for something like this that just kind of gets stuck in neutral and actually stops you out as it kind of gets stuck and it just doesn't want to make its way up. And so you can't win every trade, right? Trading is a game of probabilities, as I've said before. But what you want to do is make sure that your risk and your reward give you an edge, right? You want to make sure that you find a trading pattern that works for you. So if you're flipping a coin, you want to make sure that that coin, if it's going to be a 50-50 trade, you want to make sure that that coin gives you at least 2 or 3 times the reward as your loss. That way you're making up ground every time that you flip it 2 or 3 times. If you have a coin that's going to give you heads 60-70% of the time, then your risk versus reward could be less because you're winning more often. But you want to make sure that you balance that out and you come up with an edge where you have either an expected probability of success that's high enough where you can have a lower risk reward, or you find a situation that gives you good rewards whatever you're risking, in which case you don't have to hit them all, but you know that when you do hit one, it's going to pay for your next 2 or 3 losses. And so that's kind of what we've been trying to do. And one of the things I really focus on during these Patreon posts where we're looking at our watch list is making sure that our risk reward is worth it, because that's really the only thing you can control in this market is your risk. There's not much you can do with reward. It either goes up to where you want or it doesn't, but you really can't control that. But what you can control is where you want to exit. And so that's what we try to make sure we take advantage of. All right, so I think that covers it for today. like I said, if anyone in here has a chart request and you don't want to add it today, you can always ask me on Twitter. You can find me on Discord, or you can email me. I'd be more than happy to answer you in any one of those mediums. Other than that, hope you guys have a good rest of today, and we will meet again next Wednesday.